Hello, welcome to SuperReturn Asia 2019 in Hong Kong. I'm Sarah Clark and I'm joined by Arnaud Bonzom, who's the co-founder of the Map of the Money. Welcome and thanks for joining us.
Thanks for having me, Sarah.
The question we want to talk about today is corporate venture capital. How are the motives different to traditional venture capital? What are they and how are they different?
Sure. So venture capital firms are always looking for returns. So it's a very strong financial aspect, and it's about how you give more money to your LPs and how as a GP you make money out of that. The corporate venture arm is a very different perspective. So usually you can find them in three different buckets. Some of them are truly financial driven. So they will only look at money they can make and is aware of diversification of their main business. And that is a kind of a very small bucket. The other small bucket will be the one who will only be strategic. They only want to invest in kind of new ideas or something that can get synergy with the existing business units. And then the last one, and which is the largest bucket, will be the one who will be strategic and financially driven. So they want to have those synergy, but they want to be financially sustainable. And that is the biggest part we see. So it's why it's quite different than VC most of the time.
Okay, you mentioned those differences, but do they have the same objectives?
Well, I mean, all of them are here to create value. The thing is the VC are here to create only cash, where the corporate are cash or cash plus synergy or only synergy. So everyone is here to create value and potentially to help those startups.
Okay, and you mentioned that they've got the same goals, they obviously want to make money. Which one, who gets the best returns when you're comparing the traditional VCs versus the corporate?
Well, the part is very difficult to evaluate on a corporate is a strategic part. That part is very obscure and very difficult to know what will be exactly the return they get out of that. Whereas in the VC it's pretty easy because it's just a financial return, so you have a lot of metrics you can calculate and see what are being the return of those funds. But we have seen some corporate who have like pretty good return by building new initiatives where they develop new ideas and they know that maybe why they will survive tomorrow will be through those kind of things. And that in a way for them they have no price. If you can maintain your company alive, there is no price for that.
Corporate VCs, are they dependable? And if not, does that mean they're worse, or should you just be careful about how you apply or use them?
So the thing is, every time you partner with someone, you need to be careful with who you partner, and you should always do your due diligence. So a VC will always be here, for example, to give you a very strong incentive to grow and grow fast, and that can bring a lot of risk to your ventures. The corporate will also have other pros and cons. The corporate, if you die, may don't care much. Way less than the VC because they don't need to report to any LPs. So that could be the change, for example, with a corporate. A corporate could have his own interest to make you die. The VC usually don't have at all that interest. So it's why it's always interesting to do your due diligence and know with who you are partnering and what could be the pros and cons. And one advice, for example, that a lot of people give for corporate VC is to don't take them as a board member, but potentially to have them more as a board observer, to reduce a little bit potentially the power they could have.
And that's a safety net to a certain extent.
In a certain extent, because even if you are a board observer, you could still have influence on the board members and you still have a specific access of information. So it's not a perfect setting, but it's a way sometimes to reduce a little bit the influence they could have on the organization.
Okay, you're based in Singapore. Where's the growth coming? Is it the corporate VCs or the VCs, the traditional VCs?
So in Singapore, we will see more traditional VCs these days growing. But there is some other economy like Thailand who are completely dominated by the corporate side. So corporate are very active. The challenge of the corporate is usually it don't last. So when we look, for example, I look at more than 30 program corporate accelerator run in Singapore, very few of them will last more than 3 years. So the challenge is they go in and out and they don't have time to learn and improve, where an independent corporate, an independent accelerator will last longer, maybe 6-10 years if they do well, and then they have more time to improve and give back in a better way to the ecosystem. So that is a challenge, is the corporate can overnight almost be shut down. The VC or the accelerator, which is an independent one, will, if they perform well, will last longer. And that is a better benefit for the whole ecosystem.
Looking at the markets across Asia, which market is changing when it comes to the corporate VCs versus the traditional VCs? Where's the growth happening? And is it a case-by-case scenario?
So it's two things. The first thing is, by definition, there's some corporate who are more looking to invest, some are more looking to acquire companies, and some are more looking to partner. So that is the first thing in the DNA. And of course, based on different nationality or countries, you can see different DNA be a little bit more dominant. So for example, Japan, like Thailand, is very dominated by corporate VCs and very few VCs there. It is also that type of investment you see in those markets. Singapore, as I mentioned, it was mostly about the VC and a little bit of corporates. Indonesia is still like a lot more VC than corporate. So it depends on the stage of the ecosystem, depends of the ownership that those people want to have in companies. But you can definitely see in the same country, company behaving in a completely different way. If you look at Alibaba, Alibaba is more known to looking for complete control of the company, or 80% ownership at least. Where Tencent, even if they do acquisition, they do a lot of investments, and they are more a partnership/investment mindset. So that is different behavior, same country.
So when can VCs help, and can they align you closer to a core partner?
The corporate VC. So I think the best way to get money from a corporate is to get them as a client, because they don't take any equity, and that could be is no dilution for you as an entrepreneur. So that is the best way you can partner with the corporate, is them as a client. If you bring them as an investor, you also need to be careful. I know some example of corporate where they invest in the company, but the business unit use the competition. So is that you need to be sure everything is aligned. So it's not because one part give you money that the other one work with you. So that is a lot of work to be sure it will be aligned. Okay,
well, so looking kind of a similar issue, do they have the same strict ownership requirements as traditional VCs? So do corporate VCs have the same ownership requirements as the traditional?
Usually it's quite different. A lot of VCs will have very specific ownership they want to acquire at the time of investment, and they want to maintain until they exit. So a lot of them are very specific about that, like they want to own 10, 12, 15% at least of ownership in a company, for example. The corporate VC have sometimes a different approach. Is for them to do 1 million check, 10 million or 20 million is the same amount of work. So they don't spend it to do small check, for example. So it's quite a different, and they're a little bit less sensitive of valuation. So they will behave in a different way in terms of ownership into those companies.
So they're more flexible in their investments, the corporate VCs?
Yeah, but they will start with higher number usually. Don't go, corporate VCs will very rarely go, for example, to the pre-seed, the seed stage. They will go usually more to the Series A and Series B. They don't go usually before that.
Okay, moving on from that question, but it's the same kind of similar issue. Are the corporate VCs, are they more willing to spend on acquisitions for long-term strategic vision and financial return? Is financial return not always the main objective?
Well, acquisition is always a big question for them, and the change is, big acquisition could be very dangerous. If you have a large corporate and you buy a large startup for $1 billion and that doesn't work, as a CEO you may lose your job just for that. So it's maybe one of the reasons why a lot of acquisition are between 20 to 50 million, because if that fail out of a large group, it doesn't have a big impact. So then you also depend of the culture of the company. A company like Cisco have done hundreds of acquisition, and they've done at least half a dozen of them above $1 billion. So they're quite comfortable about doing those large acquisitions, and they're used to. But that is back to the DNA of the organization.
Arnaud Bonzom, thank you very much for joining us.
Thank you very much.
And thank you for joining us. If you want to see more conversations like this from SuperReturn Asia in Hong Kong, you can find us on Twitter. Just look for #SRAsia. Thanks for joining us.